and how do we see the opportunities in China-Asia market, and what kind of strategy would be able to capture those kind of opportunities in coming months. So let's start here. So before that, just a very brief about Premia Partners, the company. As mentioned, I'm the partner and co-CIO at Premia Partners. We are delegated ETF managers in Hong Kong. Currently, we are the #7 largest one. You can see that we are also one of the highest growth in the past few years' time. And you can see our team here, structure. I won't go through all of them, but as you know that most of us are the seasoned, experienced investor in the industry and has been managing different kind of products across various platforms as well. So the opportunities in China market that will be more exciting. I think right after the reopening in the past few months, a lot of things has changed. Particularly the market sentiment towards China market. As you know that a few months ago, let's say just only around mid 2022, people talking about China may be uninvestable. They are doubting whether China is investable at all. But after the reopening, people gain more confidence, and you can see the rally in the past few months. But now, after February, we can also see that the market is consolidating. It's not only China, but it's the overall global risky asset are also taking a pause after the strong rally. I think one of the major reasons is because of the U.S. Fed has been changing the tone in terms of the interest rate hike. After that is the lengthening kind of the inflation is also affecting the attitude towards the global risky asset. But having said that, I think for China, we're still seeing a few very positive elements will be working favorably for the China equities. For example, on the macro side, we continue to see some improvement, as we can see that the February PMI data has been also continued to improve. I would have very high confidence that in March number, in April number, those kind of data will continue to show the pace of recovery is gathering pace. And then after that, the inflation is not an issue on China. You can see the inflation is still maintaining around below 2%. The core inflation is even 1%. So we don't have that kind of structural pricing pressure that may change the monetary policy in China. And the risk factor has largely gone as well. The overall regulatory crackdown has tuned down quite a lot. And also the geopolitical risk, although there are still on and off tension between the US and China, but overall speaking, we are seeing a still improved environment compared to what we have seen last year. In terms of valuation, even after the rally, the valuation is still very comfortable for the overall China market, and also particularly the onshore Asia. We are still seeing the market is trading around 12 times forward multiples. So it's still very low compared to the global peers, around 20 to 25% discount. So given that the earnings growth we are seeing, there should be some earning revision coming forward. So there should be a slight reweighting for the overall market. And in terms of the fund flow, we expect that there will be two mainstream fund flows to be supporting the ongoing bull market. One is from the international flow. Right now, we see that most regional funds or emerging market funds are equal-weighted or overweighted China, but not the global funds. Particularly the US funds, they are still waiting at the sideline. They are not having full confidence. I think some of them may need to revisit China, given that the lockdown, some of managers or analysts haven't been to the China onshore for a few years' time. I think they have to do their due diligence to make sure what they heard or what they read is exactly happening in the onshore market. And at the same time, I think some of them are waiting for some macro number to confirm their positive view as well. So that's one thing. And second flow we will see is about the onshore domestic investor. As you know, that China A-share market is quite highly dominated by the domestic retail fund flows. As we see that in the past few months, the margin financing level, the daily market turnover is still maintaining as a very, I would say, relatively normal level. So we don't see a spike from the retail investor yet. So when the market sentiment continue to improve, the investor confidence will also will rise in the next few months. So hopefully by then we will see more fund flow coming from the retail investor and to support a stronger market for the rest of this year. And in terms of the earnings side, we may starting to see the management of the company to come out to talk to the investor, to the analyst right after the annual report. So it would be right around late March or the mid-April kind of a range. And then they will see a round of earnings revision upward. So that will also support the Chinese equities. So this is the rally that we are talking about. If you notice that starting from around October, you can see that some of the market has been turning much stronger, like the Hang Seng Index, HSCEI, the X shares listed in Hong Kong, and even the ADR market listed in US. They were up like around 40%, 50%. But onshore market, the A shares only up around 15 to 25%. So there should be a catch-up play for the onshore market and to take over the stronger momentum. In particularly, if you're thinking about a fundamental, offshore Chinese equities are quite a lot focusing in the internet business, the platform-based business model. Of course, the regulatory crackdown seems to be getting much lower, but at the same time, we don't see they have a very new business model to accelerate their growth or resume the growth rate that they has been in the past few years' time. So that's why we are thinking that in the onshore space, we will see more interesting business opportunities, particularly the hardcore technology, the new economy kind of themes that is happening in the onshore market will be more benefit from the policy side. As you know that right now, China is having the two section, the National People Congress as well. I believe in terms of policy, the announcement going forward will be more favorable to the onshore market, and particularly the retail investor in the China Asia market, in Shanghai and Shenzhen, they are more sensitive to the policy. So whenever there is a policy supported sectors, news coming up, those kind of stock will usually react much faster than their offshore peers. So that's also another angle that we see that the onshore stock could be outperforming the offshore. Another reason the support is about the earnings growth. As you can see that this year, overall China should be doing pretty well. We're talking about 20 to 20, high 20 to 30 kind of a percent earnings growth for this year. Even in the 24 next year, we are still seeing around a mid-teen to mid-20 kind of a growth. So that would be a very high growth compared to most of the peers listed elsewhere. And within that space, we are also seeing the new economy themes listed in the onshore. They will have more sustainable growth rate. For this year and also next year, we're still talking about much higher growth rate versus the MSCI China, which is mainly covering the offshore market, including Hong Kong and ADR. The growth rate next year they're talking about is around 15%. So this is a difference compared to the onshore market. And the bottom chart, the green bar will also show you that the buyback action has been very consistent in the onshore market. That is another plus. If you remember the overall US bull market in the past few years' time, one of the supporting elements is consistent buyback from the corporate side. So we are also starting to see this kind of action coming in the onshore market. That also means that the corporate or the management themselves seeing the value of their shares after the setback in the past couple of years' time. One of the key topics that we always communicate with the client is one of the key questions that they will ask is, how long can the reopening trade last for? We just want to highlight one thing about this is the household saving during the pandemic in China is significant. The overall saving went up by around 30 trillion, so doubling the pace in the past few years' time. And most of this spending power has not been released yet. If you remember, the overall reopening starting in December, and then the first month, probably everybody got infected by COVID, not really in the mood to do any spending or investment. And then the month after, let's say in January, people are talking about going back for the Lunar New Year gathering back at home. So not really in the mood to buy a lot of things or making any investment decision as well. But I think when people starting more confidence about the economy and also about a job, they will start spending. And as we have seen in every single country, that is exactly the same phenomenon. The spending power will be increased, same as also the housing as well. So we will see that this kind of power will continue to be released gradually in the next 12 months through one is the consumption. Second, potentially they will consider much bigger items, including cars or housing. And then the third will be some entrepreneur or the corporate management are starting to willing to spend in terms of the capex to boost their capacity. So that is how we see that will flow out and flow in the next few months or for the rest of this year about the overall saving. In terms of the valuation of the market, we're still seeing very comfortable. Overall, China is around 11 times, onshore Asia around 12 times. As you can see, the global peers or the regional peers, they are trading at around mid-teen level. So we're talking about at least 20% to 25% discount. Needless to say that we are also seeing a potential high growth rate in terms of the earnings. So when some of the investors are also questioning whether the global market or the developed economies are stepping into recession. So if you're thinking about fundamentally, China is improving versus the global side is dropping. At the same time, China A is trading as a lower multiple. So that lower multiple may not be justified. So that's why we are seeing a higher upward kind of a potential room for the rally for the Chinese equities. And this is the interest rate outlook for the US. I think for US, I think is a lot of focus has been there right now. This chart is made around 2 months ago when we are starting draft out the 2023 outlook. But as you can see, back then, people expected the peak rate will be around close to 5%. But now we're talking about 5.5%. So after 2 months, people start seeing a higher interest rate environment in the US. And it's more lingering kind of a sticky inflation environment. So it probably would not be very good for the overall US equity market. And potentially that will also be favorable for some switching into the overall external market, international market, including Chinese equities. In the next few slides, we just want to highlight some of the best performance or the worst performance last year so that we can have an idea last year, given that kind of background. So what will be it like this year if there's a mean reversion kind of things. So last year, you can see that the overall North Asia has been underperformed, including Korea, Taiwan, China. So this year, we're talking about potential flip. We already start seeing this kind of trend earlier in the past 2 months. So you can see that the Southeast Asian market is slightly underperforming, with North Asia, including China, is starting to show the outperformance. And then in terms of the sector performance, last year, IT, communications, healthcare underperformed. So this year, we are also starting to see slightly stronger performance year to date. This is a close-given asset class. Overall, EM is underperforming last year. So this year, there could be, again, there is a likelihood that we are seeing the peaking of the US dollar and also starting to see more favorable move for the overall emerging market. In terms of the currency outlook, I think this is also one of the key considerations when the investor put their money in the China market. Now we are seeing the outlook from the market is around 2 to 3% appreciation for the renminbi. So it's not talking about significant upward movement, but at least when you're buying the Chinese equity, you are not only benefit from the stronger stock movement, but also the currency also slightly supporting the overall investment angle. One of the key question or the concern for the China market is about the housing. So at this chart, you can see that the blue bar showing you the housing price month on month change. So China has already seen like 13 months consecutively down on a month-on-month basis in terms of pricing. And then in terms of the fixed asset investment in the real estate industry, it's also down year on year. So we are not seeing any big turnaround. But having said that, I think February already starts showing a slight change in terms of the property sales. We are seeing the first year-on-year growth in February. So last month, we start seeing the first year-on-year growth. Some of the reason is partly due to the seasonal factors, because the Chinese New Year this year is slightly early in January. So that's why February sales is stronger compared to last year. So, but having said that, even combining the first 2 months, we are seeing the deceleration of the drop is also starting to appear in the market. So instead of like down 30% every on a year basis in terms of the housing sales, we are only seeing around 10% drop. So that is a big significant improvement. At the same time, we are also start seeing some quality developers. They are able to raise funds in the stock market, in the bond market, solving their liquidity problems. So potentially less default will be much more healthy to the market. And also, as we mentioned earlier, the household saving is a lot. So when they feel more confident, they will start able to buy housing in the market. So I would expect that in the next few months, we will continue to see some improvement. And then in the second half of this year, we will really start to see some year-on-year growth positive movement. That is how we expect the housing market will be impacting the overall economy. So overall, right now, it's still a drag, but into the second half of this year, we will start seeing some contribution positively from the housing market. And in terms of the overall inflation outlook, China, we are also start seeing a slight increase this year from 1.6% last year to 2.3%, but we are still seeing a very comfortable kind of a level. And it won't change the loosening kind of a policy direction within China's space. We don't have the structural causing issue as we've seen in other economies. First, the labor market is actually pretty okay. Unlike others, they are short of labor. In China, we don't have that issue. We just come out from the reopening. So right now, people are happy to have their job and not really asking for a big raise in terms of the wages. And secondly, the overall global commodities is actually on a downtrend. As you can see, the metals prices and also the oil prices. One of the key reasons is that the COVID related kind of a logistic problem are mostly gone. The shipping is okay, and also the production is also okay. They don't need to shut down for any COVID related issue. So that is also a plus. That's why we are seeing a very smooth environment in terms of inflation, so that the policy should still be very supportive. I would like to highlight last year, given even a very challenging environment with COVID issue, with the lockdown, with the external demand is dropping. But overall, you can see the high-tech manufacturing in terms of the fixed asset investment is still having a pretty strong growth last year, up around 23.6%. Is amazing. And on the right-hand side, you can see that the foreign direct investment is even up higher. You have to think about those kind of investment, unlike our stock investment. We can trade in and trade out every single day. If we bought yesterday, we can simply sell it today, right? But for those kind of more sticky investment, fixed asset investment, foreign direct investment, they are talking about years, if not decades. So that's why it shows they are still very confident how China will grow in future. And high-tech manufacturing is definitely one of the key area for the future development. Just want to highlight one thing is about the semiconductors, as we know that there are so many tension or argument about the technology transfer between US and China. But this chart, you can see that the importing semiconductor in terms of the value and volume continue to be increased. And it's also highlight the incentive is very strong for the for China, for the Chinese government to develop their own technology to climb up the value in terms of the semiconductors and also other hardcore technology space. Here you can see different area or segment within the semiconductors. The blue bar is usually the Chinese related company. So you can see that in most of the area, there is still a very large room for the Chinese player to catch up. Right now, most of them are still very small in different segments. One of them is lower in terms of technology content. Second is about also the potential market to grab is for the Chinese enterprise to do. So this is very interesting, and we will see a very high potential for those Chinese enterprise to continue to develop, to increase their R&D effort in this segment. And another area, I think for every investor here in the call, is very important to remember is about the green economy. As President Xi himself had about the net zero, the peaking of the carbon also within a decade time. So that's why this will be a very key growth element and will provide a lot of different opportunities in the stock market. But people always referring that maybe just only on the renewables. Yes, renewable is definitely one of the key driver, but we are talking about a whole ecosystem. So there will be a green infrastructure, the new materials, the green enabler, the digital transformation, green living, and also the transportation. So it's a whole ecosystem benefiting across different industry. So I think this will be a very interesting angle to consider the green economy as a whole ecosystem rather than a very narrow aspect in the renewable space. Last year, we're talking about still a very rapid installation for solar. And as you know, that very interestingly, the solar industry is also quite dominated by the Chinese enterprise, from very upstream to the downstream wafer. So we will see that as also a very good development in terms of the technology, in terms of the export content. They will continue to also drive the export to, let's say, Europe and also the American market as well. The next one is the electric vehicles. As you probably may not know that China is already the second largest auto exporter in the world last year. So it's amazing development, and the adoption of the EV is also very high. Right now, you can see that by 2025, the overall China sales in terms of vehicle, half of them will be coming from the EV related models. So that is amazing, and it's much faster than other countries in terms of the adoption. And it's also highlight the change when people questioning the export potential for China, whether there will be a lot of factories moving out of China to other country. Will China no longer be a major exporter? EV is a very good example. Over time, you can see that China has been keep increasing their value chain, climb up the value chain of the export content. And EV is one of them compared to the apparel or other more low-end products. EV, the technology content will be much higher. And when they export those kind of products, it will also help lift the overall economy. So this is just one of the example to highlight the change of export of China over time. So in terms of the valuation, it's more interesting for the stock market is that in terms of strategy, we just want to highlight three China strategy, like BlackRock economy. We are talking about a 7.7 times forward multiple. It's a multi-factor strategy emphasizing value, low volatility, and quality. So compared to the previous, let's say 5 years, it's trading close to 1 standard deviation below the average. So it's a very attractive valuation. And the second strategy that we will want to highlight is about the new economy. Now it's trading around on par with the historical range, but we are talking about high 20 kind of earnings growth this year and also mid 20 next year. So the PEG, the PE growth ratio is still below 1 time. And the third one we want to highlight is about the Star 50 strategy. Star Board is a new board set up a few years ago, focusing on the hardcore technologies. So you will see that this one will be potentially trading at a higher multiples because they will have a higher growth. Currently, it's trading around 31 times compared to the historical average 45 times. It's still trading at a very deep discount. So overall, China, we are still seeing the value is there and not even yet a overclouded trade, because some people are saying that China is already a clouded trade, probably not more interesting from a valuation angle. But here, just want to show you from different aspects, whether it's a value strategy, a new economy strategy, or even a very high-tech, hardcore technology kind of strategy, all of them are trading below or on par with the historical average only. In terms of the correlation, the diversification effect, you can see that the new economy, the BlackRock, the first two row, when they're compared to, let's say, the S&P 500, the correlation is only like 0.3. So it's a very low correlation compared to the US market. In case you have already US exposure, or even you have a NASDAQ exposure, the overall correlation is as low as around 0.3. So, so it will provide a very good diversification effect to your portfolio. So that is the market outlook. So in the next few slides, I will just go through some of the very interesting strategy, which is different from the mainstream or the pure, simple market beta kind of approach when you're investing in China. The first one is the new economy. So this strategy is talking about to capture all the new economy stock in the portfolio. So first is a very straightforward screening from the business angle. And then we will go through the middle one, the two main filters. One is doing the non-fixed asset scoring. That means trying to find out the company which develop the business or expand the business by using a light asset model. So that is very important. And secondly, we are also screening their financial health to make sure the company themselves are very strong in the financial position. Let's say we look at the debt coverage, cash ratio, profitability, and then with that, we will getting the final stock pool of around 300 number of stock. By that, we will also weigh them, each stock, the weighting in the portfolio, and looking at the growth angle and liquidity. We'll look at the profitability, their R&D investment, but we also want to make sure they are scalable so that the investor can get in and out easily. So we will also looking at the market cap of each individual stock and also the daily turnover. So the outcome will be the blue bar here. So this is representing the new economy sector exposure. Will be high 20s in healthcare, around 20 plus in IT and industrial, and then the rest will be around in materials, consumers, and communications. Unlike the board-based kind of approach, the board market, let's say the CSI 300, the A50, or the MSCI China A, they will have a lot of exposure in financial, like banks, or even some consumer stable, utility, real estate, energies. So ours one is focusing on more high growth kind of a segment. And
Sorry,
some people will say,
David,
yes.
I need to interrupt because someone say he cannot see the screen. So I want to ask other attendees, can you see the screen clearly? If yes, you can raise your hand. Yeah. Sorry. Let me send a poll. Okay, manage. Okay, let me see. Okay, I think David can continue. Yeah. Let me. Yeah.
All right. Okay. Thank you.
Thank you.
So one of the things that some investors, they say for China exposure, they already have very good positioning, let's say in the US ADR market or the Hong Kong listed H shares. So do they really need to invest in the China A? This slide just want to highlight that some of the unique sectors or the names or the leaders are only listed in Shanghai or Shenzhen. So they are not available in the Hong Kong listed shares or the US ADR. Just like the advanced manufacturing, high-end industrial, the biotech, the new energy EV battery, the AI, and also the enterprise solution. So those kind of company are only listed in Shanghai or Shenzhen. So in case you want to tape on their growth, you can only get the exposure through the China A. So this is highlight why A would be a unique and should be a good complementary positioning in case you already have the offshore exposure. And in terms of the new economy, we also want to highlight how it's different from other index tracker or the mainstream beta, market beta. So we can see that in order to capture different main themes in the market, new economy represented higher in those kind of sector exposure. Let's say the cloud AI, we got around 16%, semiconductor 13.5%, biotech 20%, industry 4.0, 21, new energy 13.1. Usually we will be ranked the highest compared to the mainstream kind of a pure market beta approach. This one just show you the top 10 holdings of our new economy strategy. So CATL is one of the largest EV battery globally, supplying Tesla, BMW, Honda. And the second one is China Tourism Group Duty Free. It's the exclusive duty free operator in China market. And then the third one, Myray is one of the leaders in terms of the medical devices. So I won't go through all of them, but you can see all this name is actually quite big, but they are not the mega cap like the PetroChina or the ICBC, those kind of company. They are in the growth segment, but a key leader. So just want to highlight that this strategy is not a small cap strategy. Instead, it's an all cap strategy. We have a large cap, mid cap, small cap. But most of the common point of that is that they are in the new economy sectors and they have a higher growth rate. The second strategy we want to highlight is the Star 50. So for some of you may probably not heard of Star Market, is that Star Market launched a few years ago, is sort of like a baby of President Xi himself. It's initiated by him starting in 2019. So the main objective for launching this board is similar to the NASDAQ in the US market, allowing some of the high growth company without a very strong track record to get listed, to get the required funding for developing the essential technology and the business. So really about innovation and hardcore technology for this main board. It's very interesting. Just want to highlight the star market versus the other China A-shares in Shanghai and Shenzhen is that first is allow the registration base for the IPO, so it's allow more flexibility. In terms of trading, they allow the intraday 20% up and down, so volatility-wise will be slightly higher compared to the main board. But it's also encouraged more institutional investors to focus in this market rather than the retail investor. So right now is a very interesting, also the fastest platform for fundraising in the past few years' time compared to the global peers. But right now, the best approach for tapping into the stock market is through the ETF. The reason is that if you want to direct investing in it, let's say if you through the Stock Connect program, only a couple of dozen of them are available. So most of the stock are not included in the Stock Connect program. So for general investor, individual investor, it's very hard to get those direct exposure. And besides, ETF will be a much smaller kind of a basket in terms of size, will be giving you 50 different names exposure. So this is how we capture the Star 50 index exposure. And this one is a highlight by one of the brokers, Goldman. They suggest that potentially Star 50 growth will be very high in the next few years' time. Will be reaching the current size of the A50, the mega cap kind of market cap in like 3 years' time. So there's amazing growth in the next few years' time. The Star 50 index is very straightforward. It's only based on, let's say, the size of the company. The top 50 leaders will be included into the index, and then we're going through the quarterly rebalancing to reflect the timely kind of change in the underlying market. But just want to highlight one thing. In order to get into the Star 50, the R&D, the research and development content, has to be very high. Let's say the intensity will be around 5% or above. You have to sort of like have a certain spending in your business, in R&D, and also the personnel is also has a certain requirement. So you can see that that is very different from the main board. They can be any kind of business in main board, but in the Star market is a specific kind of a hardcore technology business and a very high R&D barrier. So for this sector exposure is around 44.5% in new generation IT, 12.7% in biotech, the 2% in new material, high-end equipment 9.6%, new energy 21.8%, green economy 5.2%. So that's also involving large cap, mid cap, and small cap. Correlation by, we just want to highlight this one is even lower. Let's say if you already have the S&P 500 or the Nasdaq exposure, the correlation with Star 50 is only like 0.02 or 0.07. So basically it's totally uncorrelated. Even if you already have some exposure in the China A, let's say you have the mega cap A50 exposure, the correlation is also 0.3. So that's also provide a very good diversification effect to your portfolio for the China A exposure. This is another slide showing you on the general GIGS approach, what kind of sectors that they are representing. Around 64% in IT, 12% in industrial, 11% in healthcare, and 8% in materials. On the right-hand side, you can see some of the names, and there is a very strong pipeline. Let's say in the AI software, in the autonomous driving kind of development, those kind of companies are queuing to be listed in the Star market. In capturing different kind of mega trend themes, Star 50 is even higher in terms of the cloud AI, semiconductor, new material, biotech, and new energy. So this is the top 10 names of the Star 50. So we have like SMIC, is a semiconductor foundry. We just want to highlight on the right-hand side, what are their global peers. So for the right-hand side, you may be more familiar with those kind of names like TSMC, Qualcomm, Microsoft, Fangluc, Samsung SDI. But on the left-hand side, those are the names that sort of like equivalent in what those global companies are doing. But they are listed in the STAR market and they are the top holding in the STAR 50. At the same time, you can see very interestingly, the R&D investment is much higher compared to the global peers. And at the same time, the earnings growth is also higher compared to the global peers. So these are the business slide in more details. I won't go through all of them, but you can see that they are also the clear leaders in the emerging industry. Let's say in the chip making, in the solar solution, in the IC design, in the office software, in the LED and semiconductor equipment. So that will be a very interesting angle to look at. It will be higher growth, but also higher volatility, as we mentioned earlier. A daily intraday movement of the stock itself could be 20% versus the main board is around 10%. The third one, we want to highlight the strategy on China is the bedrock economy. So similarly, we also have a screening process for this strategy. We pick out the top largest 800 company based on their total asset, book value, and revenue, and then go through two screening. The first one, similar to the new economy, we look at the financial positioning. And second, we try to pick out the stock with lower volatility to make sure the company, the stock themselves are less volatile in the stock market. And then we got the 300 number of stock, and then we weigh them back by the economic size. That's mean total asset, book value, and revenue. So within the whole filtering the construction methodology, we don't use the market cap. So we just try to take out the pricing issue, maybe overweighted by the overvalued by the market. We just want to take out that kind of elements in constructing the strategy. So essentially, the blue bar here representing the sector exposure of bedrock. So around 40% in financial, and then 10% plus in industrial. The rest will be consumer, real estate, communication, IT, material, healthcare, energy, stable, and also utility. It's more quite evenly distributed and also quite fragmented. So I would say is similar to some market beta strategy, but we emphasizing the multi-factors approach. The quality, because as you can see, they have a better financial positioning. Lower volatility, because we use the volatility as a cut in terms of getting the stock into the final stock pool, and also the value. We don't looking at the pricing element, so we will pick out the more deep value stock in the market. So this strategy representing around 46% of the total market revenue, but 70% of the total market earnings kind of approach. This one, you can see the top 10 companies, the holdings that we have in this strategy. I think some of them will be quite familiar to what you have seen in other China strategy, like Ping An, China Merchant Banks, Industrial Banks, China Telecom, ICBC. There's nothing different from most of the other China strategy, but you can see that we do the screening so that it emphasizing the different factors has been working very well. Last year, in a bear market, our strategy only down by 5% compared to the board market down by around 20 to 30%. And this year, even in a slight up market, we are still talking about around 2 to 3 percentage point outperforming the board-based market this year. So this is a very interesting strategy. If you're thinking putting a long-term investment, believing the value approach is the right approach, then this strategy may be shooting you in putting in a China space. This is another way to look at. We just compare the top overweighting positioning of our strategy compared to the CSI 300, because we both of them also have 300 number of stock. You can see that some of the banks will have a much higher exposure, like Shanghai Rural Commercial Bank, Qilu Bank. They will have exposure in our strategy, but none of them will be in the CSI 300. So this is just for your comparison. I think that is what we would like to share for this evening. Maybe we can get back to the host or open up the floor in case any question will be asked.
Oh, thanks, David. Okay, let me see what question here I have. Okay, we have one question here. That is about the China A and Hong Kong stocks. Yeah. What are the more prominent investment advantage of Asia compared with Hong Kong stocks?
Yeah, very good questions. I think if you look at the Hong Kong listed shares, first the difference is about the company and the sector exposure. You can see that most of the biggest name in the shares will be the platform-based company like the Tencent, the Alibaba, the Meituan. All those companies will be very heavily weighted in the Hong Kong listed shares. But at the same time, you're also seeing that the policy going forward may not be more favorable to those kind of companies. So right now, the Chinese, we're talking about the development in terms of the advanced technology. It's no longer the e-commerce. It's not about the people watching more live streaming or playing more games or buying more stuff over the e-commerce platform. But talking about developing the semiconductors, upgrading the industrial automation, talking about the green economy, the renewables, the electric vehicle, the biotech. So if you think about the policy on one hand, and then you look at the composition of the market, so the shares probably may not be the best proxy to capture the growth or opportunity in China. And at the same time, you can also see the rally in the past few months. The Hong Kong shares has already got very favorable, strong rally in the first round. So I would say the second one, the second uplift, will be more towards or leaning towards to the onshore space.
Okay, thank you, David. The second question is, can you summarize what are some of important government policies impacting China economy till today, to date? Yeah.
I think if you look at the two section right now is ongoing. I think some of the message from the top official highlighting or giving a signal to the stock investor what they should invest. First one, they are giving out the general economic growth target. I think overall speaking is in line with what the market has been expecting. So overall speaking, it's still a very pro-growth kind of environment. So in terms of the monetary policy, the fiscal policy shouldn't still an issue. But at the same time, you are also seeing the presidency has been saying, let's say yesterday and today, that it's very important to continue to upgrade their technologies development, to fasten it, and to figure it out what's the right way to do so, and supporting the private enterprise to continue to contribute to the China economy. I think this definitely is one of the key message that going forward, I think is the new economy kind of a segment is very important and will provide much stronger opportunities going forward. Probably not coming from banks, not coming from the insurance company or the oil company, but instead we are talking about the different element in terms of the upgrading in the technology, the robotics developments, the medical equipment or services or innovation to cope with the aging population in China, and providing a much greener economy through the zero carbon emission. So all of this is happening, and I don't think there will be a sharp change in terms of the direction. Some investors saying that, oh, we have been hearing that for a couple of years' time now. So what's new? But I think sometimes we don't really need something new. You just need the consistency and also the continuous improvement underlying from the corporate side, and then to reflect on the share price going forward.
Okay, then another question. Yes, how do you see the magnitude of impact U.S. sanctions on 5G AI chips has on the Star 50 stocks in the economy recovery of China in 2023?
Yes, yes, very good question indeed. I think the sanction, there will be some impact. As you know that, let's say, I think particular last year, Huawei couldn't get the essential chips for the 5G, so they sort of like stopped producing phone that is able to cope with the 5G requirement. But then I think is now launching the new phone right now using the domestic chips that is able to use the 5G services. So there's just one thing that will create some hiccups, some short-term issue in terms of the overall process, and will delay some of the product launch. But overall speaking, I think they will continue to improve, and it will even giving a high incentive for the domestic company to grow faster. Let's say if there's no sanction, those Chinese companies, they were still growing, but probably at a lower pace. But with those sanctions in place or more technology transfer bottlenecks, I think the future growth will be even higher for those kind of domestic companies. So I think for investor right now, we should look beyond the short-term kind of obstacle, and then to see probably a stronger future growth. If you think about that, the technology transfer, no matter how good or how the relationship between the US and China will improve, they will continue to be an issue, and they will continue to be played by different politicians in the US as a card to place against China. So I think the Chinese government definitely has very strong incentive to develop their own. EV is one of the example. I think, of course, if you some people saying that EV may not be the highest standard, but you can see the volume is also compensate for the quantity. But having said that, I think some of the key providers, not only the US but Korean, the Japanese, let's say the European, some of them do find a leeway and may also produce some specific for China use component for the China market. That may not be the top high-end range, but still capable to do the essential function for the China market. I think that is another way to route through the US sanction.
Okay, we have the last question. That is, do you foresee a high number of Chinese traveling overseas for vacation in the near future?
Oh, definitely. Definitely, I would say will be huge. Because if you think about it, as mentioned, that it just starting to reopen in December, and the first 2 months people are busy with either sickness or the family gathering during the Lunar New Year. But right now, I think with the policy between the borders from different countries also starting to open for China, I think we'll definitely see the tourists will come out from China. So people start traveling. No matter it's a business travel or the leisure travel. But we have to also remember in the past couple of months, given the shutdown, some of them may be already got expired for their passport. It's just a very pragmatic kind of an issue, right? They have to renew the passport. So all this kind of issue will come up in the initial stage, and also the airlines will also have to cope with the increasing demand from China to different countries, to different cities. So I won't have any doubt the resumption of the tourism will come back.
Okay, thank you, David. Very thank you for your today's sharing. Yeah, and to everyone in the audience for participating and listening. So today's webinar, yes, very great success, I think, and I like your passionate put forward some questions. Yeah. Now now we have something to share. Yeah, you can trade China, United States, Singapore, Malaysia, and the Hong Kong stocks with Philip Nova from as low as 0.01% commission, no minimum fee, and enjoy zero custody as well as zero platform fees. The Nova trading account is a multi-asset and multi-currency account where you can trade futures, forex, and stocks and ETFs in a single account and ledger. If you are interested in this or have any questions, you can reply to our follow-up email or visit Philip Nova official website and leave us a message. Our dedicated account managers will contact you as soon as possible. Again, thank you for the listening. See you in the next webinar. Thank you.
Thank you.
Thank you.